The problem is the bridge to get from now to growth is going to cause such an inflation in our debt situation that the interim period, the market doesn't wait. The market starts to react very quickly. And as that budget starts to blow out further and further, our debt financing costs are going to blow out further and further. And then it's on the hope and prayer on the back end that it comes. And I think it does come. Lower taxes do, in the end of the day, drive innovation, drive growth, which is why our country is the greatest country in the world economically. But at the end of the day, right now, we don't have the time to afford it to leak through the system.
As I mentioned in the daily financial news for May 19th, we have the luxury of speaking with a Wall Street veteran of 12 plus years. He works with the top 1% of the 1%. So I've got to ask, Taylor, is this debt downgrade from Moody's a big deal? Is it a nothing burger? What happens from here? And then we'll get into the whys and how comes. But let's talk about it right now. As you said, at this Monday morning, 8:05 Pacific, the market's been open for, 90 minutes or so. What say you, nothing burger or a big deal?
I think it's a big deal. It's no surprise that we have a debt issue and that the budget that is being recommended right now by the administration is going to add 5 to 7 trillion to our budget deficit over the next 10 years. But it's not a surprise, but what it has just done is take a market that was euphoric and poke a big hole through it and say, like, listen, someone's got to come out here and state the obvious. What is going on from a budget perspective? And we get both administrations, whether it's, originally Obama started to inflate the debt situation. Then you had Trump come in and reinflate it. Then you had Biden make it worse. And now you have Trump proposing to make it worse again. So it's not a partisan factor here. It is a bipartisan standard that the United States has become a junkie of debt.
Yeah. So when I looked at this over the weekend, my initial reaction was nothing burger. And I'll tell you why. I thought the first downgrade, I think it was from S&P, was significant, right? The first chink in the arbor. And that was way back. Yeah, 11 or 12. Yeah, way back when, right? That was significant. Then we had the second one, 2021, 22, somewhere in there, much more recent. Big nothing burger, didn't do anything. And then this third one, which again, I thought it was going to be nothing, but then I actually, I wasn't really concerned about the stock market. I thought it would have its, rough opening, and probably close actually up is what I was thinking it would do, which is probably more important than the open.
Is that just a function you're thinking of money coming out of bonds, fear?
I just thought it was nothing. I thought for a long time, the first one was significant and then the next two really didn't matter. But we'll get into the whys and how it comes in a minute, because I think there's a thread there we can pull on. Yep. But when I looked this morning, again, before it opened, the 30-year note was over 5, yep, and the 10-year note was like 4.54 or something like that, but over 4 or 5. Yep. That actually made me pause. Yeah. Because you could get 5% on your money for 30 years, right? There are probably some people looking at that. And the other thing, and I think you brought this up, I watched your life goal investments on IG this morning. All other debt, bank debt, or, company debt, all of that is kind of indexed here. So again, the stock market really wasn't a concern for me, but this bond market is, I think it's trying to, the bond vigilantes, the ones that basically told Trump to put a 90-day pause on this. They might be raising their hands and creating a kerfuffle. I think that's much more significant than the stock market.
And I think what it does is gives power to the overseas countries in this tariff negotiation as well, because all of a sudden now they realize, like, listen, you've got threats coming from multiple fronts now. Your rating agencies are saying that your debt is not as creditworthy as it was in the past. And now if we want to get a little itchy on our trigger finger, we'll dump a little more, putting yields even higher. I mean, this is just like, someone going into debt. As debt exacerbates, their credit score dumps. And as credit scores dump, interest rates on their outstanding debt goes higher. And it's just a self-fulfilling prophecy. And at some point, we either have to tax, which right now we're proposing tax cuts, or we have to cut spending. And we did our best with Doge and Elon stepping in, and $2 trillion turned into $150 billion, which is nothing at the end of the day. So we need to find places to either cut or we can't have these tax breaks. You can't get free Social Security without tax. You can't get free tax on tips, overtime. You get a car. You get, like, that doesn't work.
You get a car. You get a car. Everybody gets a car.
Exactly.
Yeah. So let's talk about the whys and how comes. I think the Moody downgrade, as you've correctly pointed out, was definitely in response to this big, beautiful bill from Trump. Right. They're forecasting $5 to $7 trillion on top of our already ballooning budget. And I can't look at that with any lens and say that's good for America. Right. I just can't look at that. Now, if you do try to, steelman the argument, the argument for it is all of these tax cuts will juice growth. And the only, and the only way out of this is to juice growth. So, that is an argument. That is a story to tell. The thing that's not being talked about is like the gamification that I think will come. I mean, just think about no tax on tips, for example, right? You're a consultant and, you get on a contract, and in that contract, it says, I will do XYZ for, I don't know, $500, where it used to be $5,000.
Right.
And at the end of that is, hey, here's my app. How much do you want to tip me? And there's some kind of side agreement or whatever on that. I mean, that's just one crazy example, but there's definitely a lot of things in here that could be gamed. But when I'm sure you haven't read the bill or the proposal, but when you looked at the summaries, which I'm sure you have, is there anything in there that's like that could really goose growth?
I think it all can. Right. The problem is what it takes to get there. Right. If you look at incredibly high tax nations, there's never been a success story with overtaxation. Right. That becomes a communistic type society where we just share everything. And that then alleviates any incentive for someone to go out and take risks, to build a business, to make the country better. So I'm not a proponent of just high taxes along the way. The problem is the bridge to get from now to growth is going to cause such an inflation in our debt situation that the interim period, the market doesn't wait. The market starts to react very quickly. And as that budget starts to blow out further and further, our debt financing costs are going to blow out further and further. And then it's on the hope and prayer on the back end that it comes. And I think it does come. Lower taxes do, in the end of the day, drive innovation, drive growth, which is why our country is the greatest country in the world economically. But at the end of the day, right now, we don't have the time to afford it to leak through the system.
So let's talk about Ray Dalio, because he chimed in this morning. He's obviously been a big deficit hawk for better part of a decade or more. There's actually a third way. Earlier, you talked about there's only two ways to get rid of it. You can cut your spending or raise taxes. Ray Dalio's out this morning pretty clearly saying, guys, the credit agencies are wrong. The story is worse than they're telling you, because what will happen here is the government will just print money, aka printer go burr, and they will just inflate their way out of this, thus, crushing most people. Right. The only winner in that scenario is if you happen to be an asset owner. And if you happen to be an asset owner with fixed rate debt, you like that answer.
Totally. You know what that does? That creates a K-shaped economy even further, where the rich get richer because they own assets and the poor get poor because inflation continues to eat away at the dollar that they make. And unfortunately, and Ray has talked at length about that. So that's nothing new to him. But yeah, I would frame how you get out of a debt situation as three ways. One is you grow your way out. And that's what Trump is proposing. So a growth of the economy, collects higher taxes on receipts, et cetera. The second way is you default, which we're not going to do that. That will be an absolute death spiral. Or the third is you inflate your way out. And let's pray that it's predominantly the first option there, but Ray is saying very vehemently that it's going to be the last option there, which is not a pretty sight.
Yeah. Again, when you look at this story, I have.
And what happens to the dollar? What happens to the dollar, by the way, if you continue to print and print and print and print and print?
Well, it's funny. My title for my daily financial news this morning was "Sell America 2.0." Right, and I don't know.
It seems like that's what's happening in ex-US places right now. You see their stock market doing significantly better. You see their currency rallying against ours. And some of that, I think the slogan on that is people hate the US and therefore are doing XYZ. It's
No,
not that.
they're
It's
just
them.
taking they're taking incremental, like 5% here, 5% here. But when you do that across 130 countries, it's like a real deal.
By the way, we did that for our clients earlier this year.
Nice.
In mid-January, we took down U.S. growth and we shifted it internationally. And again, it was on the fringe. It wasn't a big move. Right. And that's exactly what happens there is you essentially buy a foreign currency, which drives it up against the U.S. and drives their stock market against ours. And at the end of the day, too, we are on the longest bull run. This might be a hyperbole. I apologize if it is. If it is, it's close. We're on the longest bull run of the U.S. market versus the international stock markets that we've ever seen. So
it's got to be close. Yeah.
Some reversion to the mean has to take place at some point, and we started to see it earlier this year.
Yeah. Again, a lot of stuff going on here. I was certainly disappointed, but when I read the summary of the big, beautiful bill, it wasn't the tax savings and all of that we certainly were hoping for, or I was hoping for. To see that we could be adding $5 to $7 trillion on top of our debt is a hard pill to swallow, even if you are someone who believes that growth will be helpful. Like Ray Dalio, which I think he's been over-indexed on this, and frankly, very China happy for too long for my liking. It's he's starting to look right, at least on inflating way out of it, because that's the only option they're going to have. They're not going to default. They're not going to tax, and it's not going to grow enough. So there will certainly be some inflation. And thankfully, I've had a shirt for 5 years that says, "I use inflation to get rich. Ask me how."
Real estate, baby.
That's it. Real estate, 30-year fixed rate debt. Hard to go wrong. Taylor, where can people find you?
Yeah, find us on Instagram. And if you're on TikTok, we are there as well. Both of our usernames are at Life Goal Investments on both platforms. 60 seconds every day.
Yeah, and a lot of you ask me what I watch or read every day. One of the things that I tune into is his 60-second summaries on his IG. If you're not looking at that, you're missing out. Thank you, buddy. Take care.
Thank you.
Mm-hmm.